Stay right there. Thank you for watching this video. My name is Jack Wong, serial entrepreneur, best-selling author of Cracking the Entrepreneur Code, and also an accredited tax advisor in Singapore. So let me explain who I am. I've been a tax practitioner for 21 years. Primarily, I've been doing international tax for my clients, multinational corporations, and high net worth individuals. I'm also a big fan of Robert Kiyosaki, as I've been reading his books Rich Dad, Poor Dad, Conspiracy Theory, Rich Dad Prophecy, and of course the latest book, Second Chance. And one thing I learned from Robert is this thing about knowing tax system is important as an entrepreneur. But myself, I have this question. I think you may have this question too, if you are based in Singapore especially. So how is Robert's discussion relevant to me? Because I'm in Singapore, he said it's important to know the tax system. He says also that the tax system is designed to benefit the rich people, not the poor people. But I'm in Singapore, how is the US tax system related to me? So I want to do this video to explain to you that what Robert said about the US tax system can also be adopted in the Singapore tax model. So here's my hypothesis. The Singapore tax system also benefits people who are on the right-hand side of the cash flow quadrant and not the left-hand side, especially if you are an employee. So let me ask you this question. How many of you actually are familiar with the cash flow quadrant model? So whether you have read Robert's book before or if you have not, I would suggest that you do it. Let's revisit very quickly the four quadrants Robert talked about in the cash flow quadrant model. ESBI, E stands for employee, S stands for self-employed, B stands for business owners, and finally I, investors. So in Singapore, if you are an employee, if you are a business owner, if you are an investor, which you derive income or, the question you have to ask is it taxable in Singapore? So in Singapore tax code, whether you derive employment income or business income, if they are sourced in Singapore or derived from Singapore, you have to pay tax. And many of my clients wanted to say this, how I wish I don't pay any tax in Singapore. Well, Singapore tax rate is considered lowest in Southeast Asia, possibly one of the lowest jurisdictions in the world. So I won't suggest you do this. But let's visit employee, what happened about the tax law here. So if you're an employee, you will derive employment income. So if you have a job in Singapore, you derive Singapore employment income, right? And therefore you pay Singapore tax based on employment income. The question is this: how much deduction you can claim? Singapore employees are very deprived of claiming deduction of expenses because the Singapore tax authority's mindset is that all expenses that employees have been incurred are in the capacity of an agent, which means that the expenses eventually will be booked under the employer's account. So how would an employee claim any expense deduction as a result? So in my life as a corporate employee, I remember there's only one thing I can claim as a deduction in my own account for employment income. You guess what it is? Try again. Okay, I know you get it. This is professional fees. If you are members of a Singapore accounting profession or tax profession, or you have to pay subscription annually, which ranges from $300 to $560, or in some cases might be $1,000. That's the most you can claim as a deduction against employment income. How miserable it is. Bear in mind that in Singapore, while you are paying employment income, as paying tax on employment income, you also have to contribute Central Provident Fund, which is our pension scheme in Singapore, and it's compulsory to all Singapore citizens and to a large extent Singapore permanent residents. Which means that by the time you receive your paycheck, 20 cents on a dollar has gone to your CPF account, leaving you with only 80 cents a dollar on disposable income. And that is before tax expense, by the way. So I guess if you're relying on paycheck after paycheck, and you have been told that to put your salaries in the bank as saving, allow the bank to pay you miserable interest, which is 1% in Singapore right now, you're actually shortchanged by the system itself. If you are self-employed, so you start running a business, and again the question is that, do you pay tax? If you are running a business in Singapore, the answer is of course yes. You have to declare and pay tax based on business income. As opposed to employee, however, business expenses deduction is always more generous than employment expense deduction. That's the truth. If you ask 100 tax advisors in Singapore, you get 100 advisors telling you the same thing. Business expense deduction is more generous than employment expense deduction. So let's say if you are traveling overseas for a business trip, you have to stay in a hotel, you have to pay your airfare, you have to entertain your client. As long as you can prove that these expenses are incurred wholly and exclusively for your business, you can take it as a business deduction for income tax purposes. So that's why, in terms of deduction, it's a lot more generous. And most self-employed will choose to carry on the business as a sole proprietor. So therefore, you are paying tax based on your personal tax rate. And in Singapore, the personal tax rate is from 0% to 22%. However, the moment you start incorporate a business, so if you're serious about your business and for asset protection purpose, you want to set up a company in Singapore to carry on your business, your tax rate is dropped to 17%. So think about it, if you earned successfully a lot of income as an individual, the highest tax rate is 22%, effective from next year. Whereas for a company, you pay tax at 17%. And all Singapore companies enjoy partial tax exemption. So based on my rough calculation, your effective tax rate as a company is between 15.5% and 17%. Good or good? And also, think about a lot of the reliefs, a lot of the provisions in the income tax code that benefits what we call transfer of tax losses between companies. So if you know how to set up your structure in Singapore properly, you can take advantage of a group loss relief system, allowing you to transfer your loss of one company to the other to reduce your group combined tax liability. Again, I'm not going to be very specific, but there are actually reliefs provision in our Singapore tax code that allow you to do all this tax planning properly. You just need to find a tax advisor who is experienced in doing corporate tax restructuring to help you. And do not, once again, as an advisor, my stand is that do not do it yourself. We are here for a reason. We are here to explain to you how the tax law works for you. So let the expert handle it, okay? So respect all the tax experts here. Let them do the job for you. You are going to seek help from them, okay? Is that a deal? Good, thank you very much. So some of you might be professional investors, and guess what? The tax system in Singapore is designed in such a way to benefit investors too. So if you follow Robert Kiyosaki's saying, he said the cash flow is important. So let me ask you this question. If you invest in a company, what income do you get? Good, dividend. So whether you're investors as an individual or a company, if you derive dividend income from Singapore companies, literally they are all tax exempt. In other words, you don't pay any tax on dividend income. And if you derive dividend income from overseas companies, okay, depends on your structure. It is possible to design a structure in such a way that you receive the dividend income in Singapore and you don't pay any tax in Singapore. Again, I'm not going to specificity of how this is planned because it's getting more and more complicated, so I don't want to bore you down with the details. So just understand that there are schemes available to ensure that you don't pay any tax arising from foreign investment income. Okay? So Singapore also doesn't have capital gains tax. Unlike US, Japan, China, Australia, Korea, you name it, most advanced countries have capital gains tax regime, but not in Singapore. So in other words, if you decide to liquidate your asset and generate a capital gain, you don't pay any tax at all. So whether it's a dividend income from stock investing in a company, or you decide to liquidate the investment in the company to crystallize a capital gain, you can structure it in such a way that you don't pay any tax. But as an employee, going back to employee mode, no matter what you do, it's just employment income, you pay income tax as a result. So you think about these 4 quadrants once again. What do you think about our tax system? Is our tax system designed to benefit the people on the right-hand side or the left-hand side? And like what Robert says, I leave you to decide which side you want to go into, but the tax system is clearly structured in such a way to benefit people on the right-hand side. I hope that this video helped you understand Singapore tax system applying to the ESBI model. If you have any questions, comments, feel free to drop me a note so that I will be doing my best to answer your question. But once again, thank you for watching this video, because the purpose of this video is I've seen Robert talk about the ESBI and the tax, importance of knowing tax a lot, but no one in Singapore, to the best of my knowledge, actually do this video. So I want to let you know that what he says can be applied to Singapore tax context as well. Okay, so thanks very much for watching this video. Once again, if you have any questions, comment, drop me a note. I will do my best to answer your question. And thank you for staying with me and allow me to explain Singapore tax law applicable to ESBI module for you. Cheers, Jack Wong here in the moment for the moment, and very happy to share with you my 22 years of international tax knowledge and Singapore tax application. Cheers.